Okay, yes, sir.
The number that we're calculating, $2,170, are those like present day dollars then? Is how much it would be?
Yes, yes, it is. Accounting. And this number has a name. This number is called the present value. This number right here, $62,000, or $62,170,000, is the present value of that investment and this number has a name as well. It's called the net present value because it is the present value. You know, it's the difference between our investment and the present value equals the net present value. Okay. Okay. So far, so good. Now, yes, ma'am.
Okay. Would the $60,000 be the present value of cash outflow, and then the $63,170 the present value of the cash inflow?
Yes, that would be a good way to just think of it. Now we do have a special case situation here. Tyson, how you doing? We've got a special case situation here because we have equal payments, equal receipts every year, right? So who here has a car payment? Thankfully, my car's paid for, but I'm going to have one pretty soon. A car payment is an annuity. Because you're paying the same amount every month. You can also have an annuity. You can choose, if you win the lottery, if you buy a lottery ticket, win the lottery, you can choose either to get a lump sum or an annuity for 20 years. You can choose to either get it all today, which is generally the better choice, particularly for people who have accounting training, or you can choose to get the same amount every year for the next 20 years, net this interest type stuff. And so, anyway, this is an annuity, which means there's a faster way to do the problem. And do you see it? It's an annuity because $25,000 a year. Ekta?
Once you put the 60,000, then you don't have to pay tax on it until you take it out.
We're not even going to worry about taxes. Don't worry about taxes. Don't worry about taxes. We're not going to worry about taxes. You don't make it too complicated. You're going to get to see this 3 or 4 times in your academic careers. This is not going to be the last time you teach it, you see it. And so don't worry about taxes, okay? Promise? Okay. And Whitney mentioned there's another table, isn't there? If you look at the bottom table, what does it say in it? And really, this is the only word I look for. It says something about an annuity. I really don't know what all that gobbledygook says, but one talks about an annuity and the other one does not. And so the annuity table. So instead of $25,000 and doing it 3 times, we can go, oh, let's do it over here. $25,000, a 3-year annuity at 10%. Tell me the number, Nicole. 10%, 3-year annuity. What's the number off the table?
It would be 2.4869.
Okay, math, please. Rebecca? Math, please. There are a lot of people missing today. Well, you get points for coming, right?
Yes.
$60,172.50.
Okay. Now, it's awfully darn close, isn't it? A little bit of rounding somewhere in there. Is this going to be a smiley face as well? Absolutely, because it's bigger than the 60,000. So what have I just done? I have showed you 2 different ways to calculate the same problem. Okay? One using the first table, which is individual year by year, and the second way is if you happen to have an annuity situation, then you can do it the short way. Yes, sir. It would be, but now you've learned how to do it both ways, which is really kind of important. And it's easier to understand the second way once you understand the first way. No. The test is just going to give you the information and ask you to calculate the net present value. And what is the net present value on the board? It's not, I don't have it written down, I don't have the label, but the number is there. Alex, what is the number? What is the net present value? If I give you this information and ask you to calculate the net present value, which number am I asking for? The 2,170. If I give you all this information and ask you, Tyson, to calculate the present value of the cash inflows.
60,170.
Yep, 62. Yeah, either one of those. I mean, the answers aren't going to be close enough together that you can't figure out which one's the right one. Okay, does that make sense? So far, so good. Yes, ma'am.
Like you said, you won't tell us if it's supposed to be annuity or regular.
No.
Will it tell us if you ask us if it says to use net present value or IRR?
Yes, I'll have to.
The difference?
Yes, you have to know the difference because we haven't learned how to do IR yet. Yes.
So if you choose to use the annuity way.
Yes.
And your answer is 50 cents off of the other one, will you have both of the answers on there?
Absolutely not. I'm not that mean.
But it won't.
She clearly thinks so, but I am not that mean.
No, I'm just saying it won't have both of the answers for this. Like A won't be two numbers like this if you calculate.
No, it will not. It'll just be one number that will be somewhere between these two.
You're just supposed to pick the one that's not very far off.
Yes, in that case. Are you okay? Are you okay? You were just grumbling under your breath. How are we? JJ, don't fall asleep on me. Should you move your bag away from pillow range? Stuffing Company B, we need to do the internal rate of return, calculate the internal rate of return. So how do we know when we've calculated the internal rate of return? And I'm about to tell you. Internal rate of return is when the net present value equals 0. When net present value equals 0, then we know the internal rate of return. Did you write that down? Okay. So the internal rate of return is a percent. It's a percent off that table. When we calculated a net present value of 2170, what did we use as a rate of return? How much? 10%. 10%. Is our net present value 0? No. So what do we need to do to bring this to 0? Does it need to be bigger or smaller? Smaller. So do we need to try out? Internal rate of return is calculated by trial and error. That might be the other thing you write down. Internal rate of return is calculated by trial and error. Even your calculator does it by trial and error. It tries one and then another, and it's got a method for arriving at the internal rate of return. Okay? So trial and error. Now, we know at 10% this is what it is. So at 10%, that is what it is. Let's try another percent. What percent should we try? Remember the big little, remember the thing in a box that I had in your notes on the second or third page of the notes? That's what you should be thinking about right now. What's it?